The Reserve Bank Board increased interest rates by 0.25% at the December board meeting. That means that since May, when it increased rates by 0.25%, it has now increased rates by a whole 3% over all of those board meetings, and there hasn't been a pause at any of those meetings. The markets, we wrote a piece earlier on in the week where we were very confident that they would move by 25 basis points at the December meeting, and equally confident that they would move by 25 basis points at the February board meeting. The market was not so sure. It only had an 80% probability of a movement in December and only about a 65% probability that we'd see moves in both December and February. The key issue for the markets was going to be the wording that the governor used in terms of the outlook. In the last two meetings, he's talked about the board expects to increase rates further over the period ahead. And the market was speculating that they might soften that view by saying the board is willing to increase interest rates over the period ahead. Indeed, what he did was to continue to use that term, the board expects to increase interest rates over the period ahead, although qualified it by saying, although we're not on a preset course. The preset course concept has been used in the past, and I don't really think it detracts much from the strength of what I would call a strong tightening bias. There was an interesting change in the statement the governor gave this time relative to both October and November. In October and November, markets were giving some probability to a 50 basis point increase at both of those meetings. So the justification for not doing 50 was a strong motive in the governor's statement in both October and November. So there was a lot of emphasis on the fact that monetary policy acts with lags and we need time to assess the actual impact of the policy. This time around, we saw a bigger emphasis on inflation itself. So he talked about inflation is damaging for an economy and makes life difficult for individuals. So really putting the point home that it's inflation that is a very, very important part of their objectives. And not surprisingly, we've seen that very strong inflation report for the September quarter, where now around 80% of components of inflation are growing by around 3% annualised in that September quarter. We also saw very strong wages growth, private sector wages growth up 1.2% in the September quarter, annual 3.4%. That's the fastest for around 10 years. And we've also seen a recovery in the labour market. So 32,000 jobs were added in the month of October, which was really much stronger than had been expected and much stronger than we'd seen in previous months. So some of those inflation, wages, pressures themes that the Reserve Bank hadn't been attacking as much as we saw yesterday really came through in the statement today. However, they did point out that inflation to the month of October was up by 6.7%, down from the 7.3% in the year to September. But that monthly CPI measure is very experimental. Only 43% of the components of the CPI are actually captured in that monthly measure. And so it could have been dismissed entirely. And in a way, the Reserve Bank did dismiss it because while they recognised that it registered 6.7%, they did point out that their forecast for the year is still 8%. So 7.3% in the year to the September quarter, 8% in the year to the December quarter, meaning that inflation has not peaked, despite the fact that we saw that one-off 1 month number indicating that in the year to October, inflation had fallen to 6.7%. So what's the outlook? As I indicated, we're very confident that there'll be another rate hike in February, and that of course was very much in line with the guidance that the governor gave. On the late January, we're going to see another CPI for the December quarter, which we expect to, as the Reserve Bank expects, that number to be higher than the CPI we saw for the September quarter. So it'd be very, very difficult for the RBA to say, well, look, inflation's getting higher and higher, and yet we're not going to keep raising rates. I would also expect to see another rate hike in March, because in between the February meeting and the March meeting, we're going to see another wages report. And what we're seeing now is that Australian labour market is incredibly tight and wages growth is lifting. We're expecting to see wages growth get up to 4.5% next year. So we'll see further evidence of that before that March meeting. And then I think that there could be a break in April, but with another high inflation report coming on the table in May, I would expect to see another rate hike then. That should be the end of the cycle, because in the second half of next year, the cumulative effect of these rate hikes will really start to weigh on the Australian economy. We're only expecting 1% growth for the Australian economy in 2023. And I think the first half of the year will be stronger than the second half, because the first half will still see some of the reopening effect, will still be driven by very, very low unemployment and by the accumulated savings that households have built up. So if we are to get that profile, so we see the Reserve Bank really attacking inflation in the first half of the year, pausing in the second half of the year when the economy slows. In 2024, bringing inflation down to a level that's acceptable to the central bank will allow them to provide interest rate relief in 2024. So we're expecting interest rate cuts in 2024, and that is a very, very important part of the overall story. So yes, more rate hikes than the market's expecting in the first half of next year, on hold in the second half. But in 2024, with the economy very weak and inflation having come down to a level acceptable to the Reserve Bank, we think the way will be clear for interest rate cuts in 2024. Thank you very much.